All right, what's up? We're live. This is Gil and Evan and Joe. We are just trying to decipher what's going on in the market. This is live as of, what is today, March 20th, 19th, 20th? March 20th, Friday, March 20th at 8:30 Eastern Time. We're here with Evan Beach from Equity Prime Mortgage and Joe Oz. Let's see what's up. Evan, tell us what's happening in the world.
The true question is basically what isn't happening. It has been an absolute funhouse of of mayhem here in the last really in the last 10 days, honestly, from 2 Mondays ago where we were hitting all-time low interest rates for the most part to the bottom falling out completely and rates completely falling apart as of yesterday and going back to where we were more or less in the middle of last year, as crazy as that sounds. And I'll explain what I mean here in a minute. But we've just seen the most extreme volatility you can possibly imagine. And for people that watched the last video that Gil and I did, was that a week ago, Gil, more or less?
Yeah, I think we did on Friday last week. Yeah.
You'll remember from that class, and basically this is a mortgage-backed securities chart. And all you really need to know, quick cliff notes, is as this chart goes up, rates are going down. So as mortgage-backed securities go up, rates are going down. Also, what you need to know is green is good, red is bad. So you'll see here from the end of last year, as we went forward into 2020 here through January, obviously into February, and then we had the rates drop significantly in basically the middle of February until 2 weeks ago. We saw a big, steep rate drop, and this is considered steep. And what I mean by that is you'll see these green candlesticks here. They represent roughly these larger blips here. You're talking about rates that gained, excuse me, about 30 basis points, which can effectively mean about an eighth in rate. So anytime you see this larger jump, you could potentially see about an eighth in rate as far as a positive or rates going lower. So as you'll see here, we saw rates dip, a good, probably 0.5% from, basically the beginning of February until, really the first week of March. So then what you'll see here is what happened in March 9th, March 10th, and I'm not quite sure what that Monday was. I think it was the 10th was the Monday. I'd have to look. Was it 9th or 10th was a Monday?
I want to say 9th.
Yeah, that would make sense. So all-time low rates were here on the 9th. And you'll see this where obviously the chart's topping out here. And that's when we were seeing, to put it in perspective, we were seeing 30-year mortgage rates in the right circumstance. Again, everybody's circumstance is different. There's no such thing as cookie cutter mortgages, but we were seeing 30-year fixed mortgage rates with good credit and the right amount of money down, basically at 3% flat, which was unreal. And that was that Monday morning for legitimately maybe a 2-hour window, a 3-hour window. And then middle of the day Monday, we saw the bottom fall out. And then Tuesday saw even more of a dramatic loss. Wednesday was full on, just full absolute mayhem as far as how the bottom fell out of rates, and rates just skyrocketed. And you'll see this here, to put in perspective how volatile this basically these last 8 to 9 days here are. I mean, go back and look at the beginning of this year and see that, gradual trend up. And also to put in perspective, and I did this last week too, but I'll pull this back. I mean, this is 1 year. I mean, take a look at that. That is absolutely staggering. I mean, look at the last 10 days compared to the prior 11 and a half months. I mean, it's just unheard of. It's impossible volatility, basically. And the only thing I try to compare it to other jumps in the past or volatility in the past, basically. You know, when Trump got elected 2016, rates shot up a quarter point overnight, and people thought the sky was falling then. You know, and what that means in today's market, from Monday this week till yesterday, we lost about 1.5 to 0.75 in rate. That is just insanity, utter insanity. And the reasoning for it is there is no reasoning for it. I wish I had answers, but what's happening is we're in such uncharted territory as far as the finance market goes, you know, from stocks, from treasuries, from everything, from the government stepping in to pump trillions and trillions of dollars in to help out the stock market and to help out treasuries and hoping to help out mortgage-backed securities. It's just been utterly volatile. And again, I know that's the time I said this word, but it's the only word that makes sense. So the good thing is, as we stand today, this big green candlestick here is a very positive move that we've seen basically from noon today until close at 5 o'clock. So what this does is this brings it back to the stratosphere of rates being palatable again. And what I mean by that, just because this, you know, rates quote unquote got better doesn't necessarily translate directly to rate sheets. So we're still seeing 30-year fixed that, you know, conventional wise, you're still going to be in the low fours as of now. So it's going to take some time for conventional rates to catch up, just because, quite honestly, no one knows what to make of this market. You know, mortgage lenders are scared to put out rate sheets right now, because by the time they put out a rate sheet and a loan officer locks a loan, rates might shift 0.5% and they might get crushed on that lock. It's just, it's crazy. You know, it's the only way to describe it. But again, today it was a good step in the right direction. If we can have, and the other thing you'll notice too here is red, 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 green, green, red, red, green, and massive, massive swings one way or another. So that's really what we're hopefully trying to get away from and get to a little bit more stabilization, like you've seen in the past here, where even if you have negative days, I mean, you're talking about rates shifting maybe 1/8 on the worst case scenario, rather than
people at least know
a
what
day.
they're dealing with.
So, I'm sorry?
I was just saying people will at least know what they're dealing with, you know.
Absolutely. Absolutely. And the biggest hurdle that we're now facing is, you know, in the purchase market, is going to be, you know, people that were potentially qualified at a certain rate, that might not be qualified anymore, or that might not want their payment to go up a certain amount. I mean, that's going to be a concern moving forward, which, you know, again, makes my job very difficult on a day-to-day basis. As you can see, it's not like I have to call Tom and Mary homeowner or potential homeowner and say, hey, sorry, rates shifted a quarter point. Your payment went up $40. I mean, we're talking about $150, $200 a month. We're talking about the difference between some potentially wanting to buy a home and not wanting to buy it anymore, or not qualifying for it anymore.
Right.
What I mean by that, I'll show you, you know, kind of a real, I'll show you a real life example of what I mean here. This out of the way. So here's an example. This is basically a snapshot of a potential mortgage, and this is somebody that would be, this was FHA, this certain circumstance, but rates are rates. It doesn't matter. It's conventional, FHA, whatever. Just to give you a good idea here, as you'll see, this was at 3 1/4. So FHA rates, you know, 2 weeks ago were roughly 3 1/8, you know, 3 1/4. So using this example, this is what I might have sent a person 2 weeks ago that was trying to buy a house FHA. And this was purchase price of, I forget what it was, 300 maybe, putting, 5% down, 95 LTV. And you'll see where payments would fall. She's looking at 2102. Then fast forward 10 days later, again, this is as of yesterday. Again, rates got a little bit better today, or significantly better today. But just to give you the full swing of the example here, if rates shot up like they did, 1.25 point and a half FHA, that same person now is going from 2102 to 2291. Paying, that's a massive jump, and we're talking about a loan amount of again of 263. So you can imagine what this does. It just gets exponentially worse for the person that has a $400,000 loan. Their payment would have jumped $350, which is huge. I mean, that is enough to make a potential buyer into, I don't want to afford that, even if they thought they might not to pay. This is a great example of somebody who's borderline qualifying or not qualifying anymore. And what I mean by that is you'll see at 3.25 here, debt to income ratio, you can go up to 58.9 on the back end for FHA, and debt to income ratio at 3.25 is 54.3. At 4.5, she's now at 58.2. So it's borderline barely qualifying. So again, this is a good example of something that could potentially get pushed out of qualifying should rates slide any further. It's just a great example of what we're dealing with on a daily basis right now in this crazy, extreme volatile market. So hopefully that sheds a little bit of light on what we're talking about, at least on the interest rate front. I know, Gil, we can get into how we're trying to move forward here as far as basically processes and how we see it going on things that we're going to come across as far as delays and not. So I think that's something that's very important to jump into.
Yeah, that's awesome. I guess we've talked about like what the last year has been and then what the last 10 days have been, which is historic and volatile are the two words that I think are fair. You texted me yesterday like, oh my God, rates are at 5%. And then we basically swung back. Like what did we close at today at the end of the business day?
Well, you'll see here, I mean, anytime you're seeing massive green like this, 113 basis point is huge. And again, I know this chart speaks volumes, but this is what we watch. Like basically we're on the floor in the stock exchange all day, and you'll see these things go up, down. The MBS is really what we're focusing on, and to see it up almost 200 basis points. And this is an everyday thing now. Crazy. We used to get excited when we would gain 35 basis points in a day. Now we're like in a whole nother world here. But the simple answer is that, it's really tricky to pinpoint conventional interest rates now, because we need a couple days like this of non-swings so conventional rates can catch up. But if I had to lock somebody, even with this positive move today, they're still going to be probably in the low fours. I mean, best guess would be 4.25, 4 3/8, something like that, which is still a point higher than we would have been 10 days, 2 weeks ago. Now that should improve. Ideally the rate sheet should get a little more positive tomorrow morning and throughout the day tomorrow. So maybe we get back to that 4% flat, 3.875, somewhere in that ballpark. But again, that's assuming that we don't have another one of these, where it swings the other way and we could be back into the mid upper fours in 2 hours, so it's just anybody that's looking to make sense of it, you can't. You just have to be in the right position and trust your mortgage advisor to make the right move for you and lock in the right position, because it's never been more important than it has been now.
Right.
You could be talking about, potentially locking in the right position and saving somebody 0.5%, 0.75%. But again, this is all going to be time sensitive to when people are going to be closing. So
right. So
that's the other big portion, and the other tricky part now is going to be closing dates.
Before we get into that, if I'm a buyer right now, and I'm under contract, or I know this is the house, we've agreed on a price, we're right there, like we're just moving the final needles on home inspection issues and things like that. But I haven't locked my rate yet. Is that something that I just tell you, like, hey, Evan, like when you see it, lock it? Like I'm going to just default to you to say, like, lock my rate when you think it's right? Or how does that process work? Or what advice?
Yeah. I mean, that's kind of really exactly how it would work to an extent. Is I have to have those conversations and say, hey, you got to understand we're in the most volatile market in the history of financing. So what are you comfortable with? If we can hit a threshold and we can get you, 375 or 3875, is that something you're comfortable with? Or, I mean, I say comfortable with, but ultimately it has nothing to do with what they're comfortable with. It's where the market's at. We just don't know. We could have a crazy day tomorrow and rates could jump, and they could plateau there for 3 weeks. And somebody that's closing in a month is going to have to take those interest rates. There's just no way around it. So I can do the best I can for them. And if I see a day like we have today, and it happened today where it made sense for 2 or 3 people to lock and they can take a deep breath, then that's what we're doing. But, ultimately it's, people aren't able to choose their interest rate in this environment. It's, you got to be, if you're comfortable with the payment, you're comfortable with the rate for that current day, you lock it and you move on. That's all there is to it. You can't, this is not a gambling environment by any means. So if you have a day like today where you had some gains, you're going to lock it and you're going to set it and forget it and move on. And, as I said last week, shut off CNBC, shut off the ticker on your laptop and leave it alone. That's one less thing you got to worry about. There's plenty of other things to stress about in the world right now. And if you can get a decent interest rate, again, we hit on this last week, Gil. Historically, whether we're at 4.5 or whether we're at 3.5, but still historically fantastic interest rates.
Right.
The difference is we're seeing point swings every day. That's the thing that people have to understand, is that, again, historically, you look back, 4.5% on a 30-year fixed is fantastic. Ask the people that had homes in 1983 how good that interest rate is.
Right.
You
texted me 5% yesterday. Everybody that's been shopping this year is like, oh my God, that's the end of the world. But
it's floored. But ask the people how good that interest rate it was in 2003. I was in the business then. The refi boom was because people were at 8-9% and they were going to 6.
In 2006, my first house I bought, my interest rate was 7.9.
Exactly. So great point. I mean, that's how people have to look at this. And while it's crazy volatile, it's just, you're going to get people, and it's like anything, man. And it's keeping up with the Joneses. Well, how did my buddy that just bought a place 2 weeks ago, how did he get 3.25%? That's going to be part of the market now. You're just going to see swings like that. It's inevitable, and it's nobody's fault. It's just where the market's at, and we can only do our best to guide people along and lock them in the right space. But inevitably, you're going to have people that are going to be in a weird position trying to close in a certain time frame that are going to get what they consider unfavorable interest rates to where the market's been for the last, call it 3 months.
Right.
But again, it's a fluid situation. This is constantly changing on I say hourly, but it's even shorter than that right now.
Right.
And it's taking rate sheets longer to catch up just
Right.
because everybody's so skittish to put out, certain mortgage rate sheets because it's, terrifying for mortgage lenders to lend money right now. And again, I know, Joe, that's what you touched on before. There's a handful of mortgage lenders that aren't even accepting mortgages right now. So
That's just because it's so volatile that they don't want to take the risk and trying to quote a rate that's just going to fluctuate where they could get burned on either end of the deal. They either didn't make the margin or they're now overextending themselves when they could have made it or whatever, or they're
yeah. I mean, you had a perfect what you have was just basically a perfect storm of everything flowing into one. I mean, 3 weeks ago we had 2.5, 3 weeks ago we had a massive refi boom where every single person in the country, I mean, it made sense for 75% of the country to refi. So you had a massive influx of applications. So you already had mortgage banks that were inundated that weren't accepting any more applications. And now this happens and it's completely thrown everything for a loop because you have a backlog of existing applications and business that is trying to get closed that's already locked. And now you have this going on. So it's just a perfect storm of nobody knows what to make of it. And that's why we're at where we're at with this volatility. So, again, and we can elaborate and talk about this for hours and get really nerdy and specific with it, but this is a great example. All you need to look at is these last, these last
it's super volatile.
basically 10 days.
I guess to boil it
Yep.
down, I guess where do you see it going from here? For boil it down to the average home buyer in Ocean Monmouth County or whatever, or we can talk broadly. Like we're also in Orange County and we have a little bit of a pulse on the rest of the market. But like, so far when we've been talking to people broadly in the market, like everybody that's in the process is like trying to expedite the process because they don't know if they're going to be shut down or if municipalities are going to close, and
Yep.
a lot going on. So they're trying to like scoot everything in, and if they're under contract or agreed, I have been the pulse on for us with all of the transactions that we have in process. Everybody on both sides actually is like moving forward in like really good faith and trying to expedite things just to like commit to that plan. And it seems to me that there's anybody that's like in the market, has been in the market, is like still very eager to buy right now because they're like they've already made that leap and they're trying to find somewhere to land. What's going to happen in a month or so is, if anybody says they know, I think they're full of it. I don't think anybody has a crystal ball right now, but I guess in terms of like where the rates go, like, can you give us just like a best case, medium, and worst case scenario for like where rates could or might go, and like what factors to look for in the news that might like swing it one way to or the other?
Well, you just hit on a good point. What factors to look for in the news? The bottom line is there are none. Normally, the average, consumer that's potentially shopping around for a house I could give them pointers, and I could teach them a class on what to look for. I could send them the login for this chart that we're looking at here, the MBS chart, and I would say, hey, you can look at the MBS, you can look at the 10-year Treasury, and normally, 10-year Treasury going down equals rates going down too. But that just has not been the case in the last 2 weeks. Same thing stock market wise. We hit on this last time, but that day that we did the last recording was the stock market went down historically, right? It was down 2,500 points, right? The day that we did the last little recording here, and rates went up.
It wasn't good.
Yeah, absolutely. And rates went up. So, I mean, there's really there's no cliff notes that you can give anybody to look at this. And a great example is I had 3 or 4 people reach out to me today telling me that they wanted to refi because they heard rates were so low. And, you know, of course, we're with, again, not to launch into refis, but we're just basically taking refi applications and sitting on them and waiting for the rates to potentially. The news cycle is so far behind. I mean, rightfully so. Obviously, the news cycle is only the coronavirus right now, and I get it because it's the biggest influencer worldwide in history, basically. So as far as where mortgage rates are, they're changing so dramatically on a day-to-day basis for the news to cover them, and unless you're really watching like CNBC like a hawk and they bring in a mortgage specialist and he tells you about what's going on, they're just going to be so misinformed.
They don't have the time for it, though, because everything on TV is like a soundbite. You know, there might I don't know if is there a podcast that you'd recommend or something for somebody to like really nerd out on this? That's like, you know, they really want to be informed. Like, just popped into my head right now, but like,
not really. A podcast is going to be, you know, unless they're doing something, you know, and Joe mentioned we want to do these frequently. Unless you're doing these, you know, almost on a daily basis, they're out of date in 2 to 3 days in this market. You know, the days of giving a weekly real estate mortgage update are gone. I mean, look at what's happened in.
right.
I mean, look at what's happened in not even a week. We're talking about 3 days. Look at this. I mean, rates dropped 1.5 and went back up in a matter of 2.5 days.
Yeah,
so,
you texted me yesterday at like 3:30, I think, and you were like, it's 5%. And then that's like not the story today.
Truly was. I mean, look where we were. I mean, this is right here is where we were. I mean, that is I mean, I could again go back and not to nerd out on this stuff, but this is where we were. We were at 98, 98. And I mean, let's see if we can even get there. And so we're talking about going back to, I mean, basically end of 2018. And guess what rates were at the end of 2018? Right? I mean, Joe, you've been selling houses a long time. Rates for purchases then were in the high 4s. You know, that's where we were. So it makes sense. I mean, this isn't stuff that we're just fabricating or you know, making up out of thin air. That's where we were. So, you know, again, this stuff is moving so quickly and it's such a rapid pace that you really, the only way to educate a consumer is to stay in touch with them and to have them pick your brain. You know, until we get to a point where we're back to this.
Right, where it's less volatile.
I mean, until we see, and I would say a week, but until we see a month like this, I mean, it's going to be a rocky road trying to nail down what's going on financially. Because again, you know, I'm a positive guy. I'm not a doom and gloom guy, but we're not going to see the economic ramifications of what's happening right now for months. You know,
I want to just people's attention span, and mine included, are one thing, especially after this week. But like, I want to talk about like people that are in the middle of a transaction right now. What does it look like for closings in terms of things shutting down? We talked about this with title companies and townships closing and CEOs and things like that. Give me a rundown of what to like if you're under contract right now. What is the next, whatever your 2 weeks or 30 days or 45 days? If you're on a 30 or 40 or 60-day close that got under contract in the last 30 days, like what do you tell me if I'm a buyer and I'm under contract right now, or a seller and I'm under contract right now, to expect, or to even
I'm flat out telling people that they have to be willing to accept some delays for, again, a multitude of reasons. You know, you're going to have a half a dozen things that could potentially slow up a transaction, from even when you have a signed agreement. And it happened to me just today. I had a deal where the seller didn't want a home inspector to come in. because they're scared to death of coronavirus. Didn't
Right.
want the home inspector to come in. That's typically step one, right, of any transaction.
Right.
So if that's getting hung up, obviously it's going to put a delay on everything else. Then you're going to get into, once home inspection's done, you're going to get into appraisal issues. Not just people not wanting people to come into their homes, but there's appraisers that don't want to go into people's houses right now.
Right. The physical act of
So
somebody's
we're hoping to have some clarification. They're going to start allowing, they're going to start allowing potentially drive-by appraisals, basically. So there's talk of that happening within the next few days here, which would be a positive move in the right direction to try to streamline some things, but we'll see how that goes.
Right.
But again, appraisals are an issue. Then you're going to get into, as you move along, getting past those two hurdles, then you're getting into towns and counties, if they're open or not. And what that's going to affect is obviously your CO. If a county shut down and they're not doing CO inspections, that's going to be an issue for a seller and a buyer.
Right.
Now they're also working on doing some virtual CO inspections, FaceTiming, whatever is possible. So everybody's working to streamline this, but again, we're in uncharted territory, so it's a very fluid thing. But we have heard that they're trying to go down that road to try to do that.
I can speak to that a little bit, just in the deals in our pipeline right now, like the transactions that are in flux and right in that phase of the CO. Like townships have actually been like, I got to give props to the towns in Ocean and Monmouth County, have been like pretty accommodating and like understanding of the circumstance, and everybody's like working together to. I put in our group chat within our group, like, hey, this is what like business should look like. This is what like a real business looks like. Like the real estate industry before I got into it has always been like, I know that it's something that there's a lot of inefficiencies in, and a lot of delays, and a lot of people involved, and a lot of inefficiency into. And like the situation is like, on a positive note, like forced everybody to become way more efficient, and to give props to the town and the local governments around here. People have been like very, very accommodating, and like offering electronic services, and being able to like do affidavits, which is like super great, because like we've been in these properties a bunch, we've seen them, we've been through the home inspections, we know that there's a smoke detector in each room that needs one, and you're basically able to just like verify that, and the townships accept that. And we had one turn around in like 45 minutes yesterday.
Yeah.
From start to contact.
The good thing, again,
had a physical cert, paid for it, had it done, and got it notarized in like within 45 minutes, which was awesome.
That's great. Yeah. I mean, and I think everybody, the silver lining of all this is that this is affecting every single person on earth. So it's not like, oh, this one real estate team's having a tough time, boo-hoo. It's every single person across the board. So everybody's going to be working together to try to close deals and to hold everything together. So that is one of the positives, is that, everybody has been working kind of in concert to try to push these things through and figure out a way to get things done.
Right.
Nobody wants to have all this come to a halt. It doesn't benefit anybody. I don't care who you are, if there's going to be these long-term delays with this. So,
right.
The short answer is we're pushing to hit closing dates, and we're planning on hitting closing dates, but people have to be realistic, because we're dealing with stuff that we've never dealt with before all over. COs, and then there's an issue if counties are closed. The issue for us and for title companies is, if counties are closed, how do we record mortgages? That's going to be a hurdle that we're going to have to deal with, because a title company's not going to leave their butt in the wind for a $400,000 mortgage if they can't record it, or at least get the intent to place the lien. So that's going to be
where's the Ethereum smart contract startup for that right now?
What's that?
I was joking. I said, where's the Ethereum based smart contract like crypto?
Yeah, I mean, honestly,
into the middle of it.
Yeah, no, I think that again, I'm a big positive silver lining guy. I think when we come out the back end of this whole thing, I think it's going to be positives for our industry because I think we're now going to have a few more tools, in our tool belt, so to speak, as far as doing things virtually and getting things done potentially a little quicker, and you're not relying on you know Joe home inspector or CO guy to go and do this or that. I think eventually it's going to streamline a lot of our processes.
Right.
In theory, anyway. That's what I'd like to believe.
What else, is there anything else to touch on in terms of closing? To expect delays, people are working together. Any other advice for people that are in the middle of the process right now?
No, I mean just if they've locked their rate or not locked their rate, try to lean on whoever's doing your financing, even if it's not me, and and just seek their counsel and lean on them and pick their brain for that. And just, yeah, I mean, stay the course. I don't think you mentioned, people really trying to get things done rapidly. I don't think that's a bad move right now. If you're under contract and you love the property and there's no reason for you to pull back, then yeah, move forward. But again, it's unrealistic to not expect some sort of a delay. So again, somebody that's trying to buy a house right now and is in the initial process and putting in offers and things like that. I mean, again, I would say 45, probably push 60-day closes at this point. But somebody that's under contract and has closing dates and is moving along, yeah, just stay the course and hope for the best, really. But again, you gotta understand if things get pushed a week or two, it's no one's fault, really. It
Right.
truly
We had one that was like, I was like
isn't.
I was just following up on a mortgage commitment for a property that's happening. It had a closing date next week. And, we just followed up and said like, hey, where are we at on getting this done? And they're like, we just switched to remote work today. Everything's insane. We're not closing this week. I'll get back to you when I can, basically. And I was like, totally understood. It's really crazy, people are dealing with kids at home, sick family members, or just like having just all the impact, or some family members losing jobs and things like that. Like, it is really crazy, extenuating circumstance for a lot of people. I guess to try to wrap this up, because we're going to do it more frequently. I don't know, man. Like, where do you see it going? Like, is there any? I don't know. I don't have a closing. My brain's kind of crazy.
I mean, I see it. Again, I see it. There's a lot of unforeseen things. We're in kind of uncharted territory. And my quote that I loved from last week that I said was like the new normal is that there is no normal. So people have to basically brace for that. And it's not necessarily the sky isn't falling, the world's not going to end. We're dealing with this as information comes out, and eventually things have to stabilize. It's just a matter of if and when, and that's all going to depend on how long this stuff lingers and how much worse or better it gets in a certain time frame. But as far as if you're asking specifically interest rate wise, I mean, I think today was positive. I would, and everybody, all the experts seem to think that we should get back to potentially levels where we were 2 weeks ago, interest rate wise, just because the economy can't handle it. Truly can't. I mean, I showed you an example of that one mortgage earlier where payment went up $190. I mean, that will dramatically hurt the housing market if rates were to hover a point and a half higher 2 weeks down the road. That would very much hurt not only property values, but the pool of buyers that you're going to have. The ripple effects would be huge. So you can't raise the cost of money when people can't afford to borrow it, is the best way to look at it. And we're going to have a huge unemployment number coming up in the next few weeks here. I'm sure everybody would, that's the one thing everyone's going to agree with is that unemployment's going to go way up. So you can't have interest rates rising in that environment. It just doesn't make sense. So I believe, and most of everyone else in the industry think we're going to hover back down. You know, might not hit that all-time lows that we were at 2 weeks ago, but if we can get back into the healthy range of 30-year fixed being in the mid to, you know, maybe high threes, I think that's a comfortable range to get back into. So ideally, you know, that's where we get. But again, as you said, nobody has a crystal ball, so nothing would shock me at this point. So if it makes sense, lock it, set it, forget it.
Right. What would the what's the contrarian view on that, as opposed to like everybody, most of the people in the industry are expecting it to sort of hover in the mid to high threes? What would be?
Well, the best way to put it is that if rates are at 5% 60 days from now, we have way bigger troubles than mortgage interest rates. It means that the economy is a complete disaster, and we're probably, you know, again, I'm not doom and gloom guy, but these are facts. We're going to be in a recession. There's no way around it. And if rates were at 5% or higher in 60 days, we have way bigger troubles than interest rates on mortgages. It just means that the market makes no sense. So, you know, that seems to be the universal feeling across the board. So hopefully that's the case, and you know, the former comes true, where we're back down and interest rates, you know, creep back down a little bit. So, but again, like I said, can't be crazy greedy in this environment. And historically, if we get to, you know, 3.875, 3.75, those are fantastic rates in the scheme of things here.
Yeah, in
So,
the grand scheme of things, like things are still pretty sick in terms of where they're at. Even if it was 5%, it's like at the grand scheme of things, that's not totally insane, or doesn't sound insane. But like you said, it's like a totally different world. Like, I don't know. You look at the stock market, it's down. It seems like it's down insane. Then you zoom out to a 40-year chart, or even a 15-year chart or whatever, and it's like it's a huge correction. And who knows where it's going to go? You know, some people think it's going to go way further lower. Some people think it'll be a V-shaped recovery. I'm not smart enough to make a call on either way at this point. But
yeah, and I think you hit on it earlier too. Like every single person and consumer is going to look at everything in a fishbowl. You know, what's happening. Everybody wants information instantly. You know, and they're going to look at everything very short term, and they could look at this chart and be like, what the hell is happening? But you pull it back, like you said, and historically we're still not in terrible shape. It's just seems like everything's crazy because in the short term, but again, it can't keep up like this. It just makes no sense. And there's a reason why it's happening. You know, obviously the coronavirus is the major proponent of all this, but you know, that has to settle down and go away at some point.
all right, I'm fried. And I'm in it every day. So I would imagine people that aren't really in it every day are totally fried. Let's call it quits for now, and then just recapitulate in a day or two and see where we're at. Thanks, Evan. Talk to you soon.
You got it. Later.